Right, back in business. Okay, hopefully everyone's been enjoying a bit on psychology, or at least seen something in themselves, or maybe not. Maybe it's just been interesting or not. But the whole idea of that is just to try and give people a bit of a structure, a bit of a way of kind of trying to understand what it is that may or may not affect them in the way that they trade. And then a few other things to kind of think about, particularly the idea on prospect theory. I think is really, really important from a trading perspective. So there's kind of a bit of my take on that and the implications it has for trading. A few questions. Thank you, Jason. Hopefully you should be able to see it here. I just remind Mike. Let me know if you guys can hear, because it looks like it's fine. It sounds fine to me. But assuming everyone can hear, thanks to Jason. Always some pretty decent questions. He's put a few. So I've actually done a little bit of stats to try and show a few things for you on this, Jay. So I've also got a more detailed sheet about the example that I referenced in the, well, possibly on the first day, in fact. So I'll touch on that. Right. Touched on it a few times, but wonder if you could expand a bit more. During day one, you shared an example of a pro trader performance. When it comes to winning, losing days, not trades, what is the reality of a new junior trader? How does it change over time? Okay, that is, I call this trader the sort of junior who's actually got a decent bit of time behind him. So that's his entirety of this year, winning versus losing days. So that's what you get. Winning days, that comes out at 37%, and that's 63 roughly. So you're looking at losing on a third of days, approximately.
But he was still profitable?
Yes, he's still profitable. He's not astoundingly profitable, but he is up on the year, predominantly towards the back end of the year. And what I'll do, a bit later on, so as to not actually put his name on the screen, because I can't show the P&L curve without his name being there. But I'll screenshot it so you can sort of see the performance. Essentially, a lot of the performance has come, and this is the case with most people, and I've got a couple of other examples of this. For most people, it has come probably since August. Apart from that, there was a lot of sideways throughout much of the year. And that's something that you have to kind of, always remember that it's not just about day by day. You've got to look at things on a weekly or monthly type of basis. Everyone will go through periods where there's just nothing going on, nothing's running for you, the strategies that you have aren't fitting that environment. If you go back and look at what it was like at the beginning of the year, you had a situation where volatility was relatively low, there wasn't a great deal of changing of central bank policy, you knew where it was going even if it was changing, everything felt reasonably calm. And when you get those types of situations, volatility drops off, particularly, and this is something from a psychological perspective, particularly when you've had a couple of years where it's all go on data, on news and on all of that, it's a hard thing for people to step back from and kind of accept that actually there's nothing going on. People try to emulate or achieve the same levels that they did the previous year. And this is the kind of thing where you have to kind of just step back and go, okay, well, I have to lower my expectations. It's something I didn't touch on it in the sessions, but the idea of regression, and that you have to look at some years as somewhat anomalous. If you have a year that everything stacks up in line with the way that you trade, it's stuff that you understand, it's stuff that you're good at, you're going to have an astounding year. Now, yes, that's partly to do with the fact that you've recognized the opportunities, you've nailed it, you know what you're doing, you can say, yeah, I'm a pretty decent trader. But you have to also accept that part of your performance comes down to the environment that you're in. 2022, for example, 2020 is an easy one, but all of those types of situations, the environment sets up for you. If in fact, 2022 is probably the best example. 2020 was about being there and put in the 15-hour days in every day for a month. Take that away and you're on to 2022, and then it was just trade, high volatility, lots of trading opportunities. You have to accept that your performance over time is going to do that one year, and it's probably not going back there again, at least not for a long time. I might try and do this as a stats thing, so we've probably got them now for the last few years. Show traders kind of peaks for, if you could show, effectively the peak of the year for each year, you'd probably see a situation where for most people, if you went 20, 21, 22, 23, and then 24, I don't reckon there's many traders that would have reached that again. They've probably done something like that. and that's probably where most people are. If you kind of did that as their peaks.
So they're still profitable, they're just not.
Most people are still profitable, and you have to kind of look at it and go, well, this is mean profitability or median profit, however you want to call it. That's your average, right? These are exceptions. And the only people that are likely to beat those exceptions are people who are not high experience at the time. If you're 2 years into your career in 2020, you're 4 years in 2022, I'd expect you to comfortably beat 2020 performance. Someone who was starting in 2007, 8, I'd be surprised if they beat that, possibly ever, because of the level of opportunities and this, not just the number, but the scale of opportunity. It wasn't oh look, there's another big 30 handle move in the S&P. It's, oh look, there's another 200 handle move in the S&P, a piece of news, and it goes another 100 handles. That was kind of the level of stuff that was going on. And constant volatility, so there's constant trade opportunities. So you have to kind of, and it is a hard thing because not many people have got enough data to go, well, this is my average level of achievement. And also you're never at that point where you go, well, this is now a plateau, because for your first few years, you're relatively going to shoot up like that. And your rate of growth will slow down, but you're still going to be growing.
You can't base it on your P&L pretty much.
You can't within reason. If you have a year where you make 5 times, 10 times what you did the previous year, you have to accept partly that, yes, one, you're probably a better trader, but also it's somewhat anomalous to 10x your previous year's performance. Unless you had a stinking year last year, that's easy to 10x. But if you, I don't know, if you're 3 years in and you make 100 grand and then you make $1 million next year, chances are you're not going to top that for a while. It's that the circumstances fit. I think that's part of the difficulty people had this year, that there were no big opportunities early on. So whilst people are trying to achieve what they did in 22, even 23 wasn't bad, there wasn't that. And that's kind of the reality of what happens. I might have to try and see if I can find some of the stats on that. Try and find some of the traders who've been here for that long. But that's something that you need to sort of stay quite aware of, just to manage your expectations a little bit. That's that trader. I'll show you so I got all this. I did some more detailed stats on a few people. So that was where that all came from. So to give a comparison, this is that same trader. No, it's not. This is that same trader about midway through the year. So not dramatically improved win rate. At this point, it was basically flat on the year. He's up a reasonable amount now. Essentially, the way that he's got to that point is he's hit a few more of these big up days. Not massively improved the win rates. It's the hitting the bigger up days. But you can improve the win rates on a day-to-day basis. And what I mean by that is, it's not about smashing more really big days. It's about just some of these smaller losing days. If you can just tip them positive, that's quite a significant shift in your performance. That's kind of the thing that you need to be aiming towards at this point. But that's a year in, basically. This is his second year. That's a third year, and much more sort of 50-50. That's 3 years in, and then that's 8+ years. So you still, there's only so far you're going to go in terms of significant number of up days. So that's also something to remember. It's not about trying to dramatically swing the numbers of up days. It's very, very hard to hugely adjust that. You've got to take some risk. The only people who manage that to have virtually no down days are the people who are generally one of two types. Extreme technical, the kind of people who literally do nothing unless it's an absolute perfect setup. So they won't have a huge number of days traded, and they will win on almost all of them, and they'll be able to swing that to sort of 90%, something like that. The other people are the just all-out scalpers, the type of people who will not trade news. They will not get sucked into any of the story, narrative, etc. They're just going to trade a few scalping strategies, a few just straightforward strategies, tick, 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 tick. They're few and far between nowadays. You don't see many people like that. But they're also the people, and the reason that they can swing that up is they can sit there and just battle back. So, a lot of the time, people like that will not have particularly astounding P&Ls. And if they go down on a day, they can sit there till 9 o'clock and just fight back until they can get themselves back up. They won't every time, but a lot of the time, essentially, it's a game of time. If you have enough time, you'll be able to get yourself positive on the day. I've known a few people like that, and they'll creep up, and then they'll have a streak where the volatility is just right, and they'll absolutely run away with it for a month or two, and then flatten off again. That's probably one of the psychologically hardest things, is the sequence of performance over time, not the number of winners, numbers of losers. It's going through these streaks where you don't really make any money for a period. That's the hard bit to deal with. So yeah, that sort of gives you a sense of where you'd be trying to sort of get to. If you can get your win rates to about 50-50, I think you're generally in a good place. Key to that though, win rates at 50-50 is one thing. It's the number of up days that are significantly above, or the frequency of large up days that really makes the difference. That's ultimately how you make your money, and that's pretty much the case for everybody. On that, there was then, Jason had a second question around practical implications for psychological as well. Do you find that some traders will naturally look for certain strategies that provide more consistent up days at the expense of potential greater P&L with strategies which have more negative days? On the whole, no. I picked out two examples here. So these are probably the two better performers of the year. They are completely different stylistically. One is extremely intensive, large number of trades on a day-to-day basis, trades anything that moves. The other is extremely sort of process orientated. It's not perfect like strategy, but very sort of process and going for the bigger trades, essentially. The simple way of doing it, that's about where the middle falls. So you could roughly, I hadn't worked out the precise percentages, but I'd say probably slightly leaning towards a higher percentage of losers than winners, but I wouldn't say dramatically. But on the point of...
That's one trader's P&L, so they've had a cluster of days where they've lost.
This is all days this year, sequence low to high, and then put in a chart.
A cluster of days where they've lost a couple $100 grand.
Yeah. But yeah, not in any kind of sequence. This is just the sort of magnitude of winners to losers. On the whole, no, I don't think there's many people who would sacrifice a big up day for consistency, just because that's far harder to do things consistently, in the sense that as markets change, you're not going to be able to achieve the same numbers on a day-to-day basis. So if you don't make hay whilst the sun shines, as you say, what you'll end up with is consistently good and bad performances. And so if you kind of take away a lot of the end and the end there, you end up with this stock just matches itself off, and you end up with not a great deal of anything. Yeah, at the end of the day, it's the tails which is where you get paid. You have to assume that most traders, not even assume, you have to assume that yourself, you're not going to outperform everybody else in the market on a day-to-day basis. So most of the time, you're going to have some small winners and some small losers, and that's around about it. So if that's the case, your small winners and small losers cancel each other out. It's your big winners and your big losers, which is where it makes the money. That's essentially the big difference. So no, on the whole, I don't think there are many people who will look at that. Most people will fall into looking for extremes, because again, the way to counter trying to get consistent performance day in, day out is to not do that and to look for extremes. So the people who might be able to get more consistent, higher day-to-day win rate, which is nice for your psychology, are also the people that you're fighting a different psychological battle. So for example, a trader that is going to be far less frequent in their trades is going to take some bigger hits occasionally and some bigger winners occasionally. They kind of cancel out a lot of this fluff in the middle and only go for extremes, which not every extreme situation or perfectly scenarioed up situation plays as you want it to, and if that happens, you end up losing. So it's how you want to sort of take it. The psychological aspect of trying to find consistent winning strategies is that it creates a huge amount of pressure on that trade. The trade comes along, you better win on it because you're not doing another trade for a few days, and if you lose, well, now you're sitting there and the next trade becomes even more significant. So this is a case of somebody who's quite happy to take winners, losers all day long, on the basis that over the long run, you will find a few days that happen to be just right for you, and you're going to end up with some of the bigger winners. There's quite a sort of noticeable jump there from sort of 120 upwards. So it goes over 120, it's going way up. And it's those kind of days where something will have happened and you get that big jump. And so, but that's a symptom of being able or willing to just trade all the time. You'll find those.
Inspiring.
But like I say, that's what you end up with. That's then equity curve throughout the year. You will end up with these periods of drawdown, and that's what you have to kind of try and deal with. Even somebody who's constantly trade will still go through sequences of losers. That's peak in April and the lows in July. So that's basically 2 down months, and you just at that point, pretty much halved the P&L. And you have to kind of accept that, and you look at it again over the long run, and you go, but something's probably going to come up. This is the point of, and this is where consistency comes in. If you consistently look for the same things that you look for, you know what you're good at, you know where you make your money, you will get streaks of opportunities that come your way. Things like August and all the volatility that kicked off in August, and then basically September onwards, where you've had some of the central bank change, you had the election and all of the polling around elections. We're now getting the heightened geopolitical stuff, and you get these streaks of performance, and that's ultimately what you're waiting for. You kind of have to weather the storm in between that. That I think is probably psychologically the hardest thing, that people assume consistency on almost a weekly basis, that you can have week after week after week after week of winning weeks, and you don't. A lot of the time you will drop back quite a long way, particularly once you're up as well, because once you're up, you're then effectively using that money to try and make some more money, and you will go through streaks of losses. That's a case of being able to sort of step back, and it's more to do with, particularly the further you get in your career, it's more to do with generally there isn't the opportunities that you're good at. You can't make money out of non-opportunities, doesn't matter how good you are. You might be able to make some money in a not particularly conducive environment, but you're not really going to make any.
It feels relaxing in itself. Like, you could sit there stressed, but why are you stressing? Nothing's going on. There's nothing you can do about it.
Precisely. Well, the reason you're stressing is because you feel there's a requirement to make money, and that's what stresses people out. Because yes, you could go, but at the end of the year, my P&L is going to go here. But it's for a long, if you sort of have that, that's your dream consistency, right? So come the middle of the year, you are a huge distance from where you think you should be. And that's not even to, extrapolate P&L for the year. That's just in your head, you should have been consistently ticking up, and you're worse off than you were in April. That's where that sort of pressure comes from. And that sort of, oh no, I haven't made any money. And it is a case, I've referenced this like very early on, that kind of realization that you will go through these periods where there's just nothing going your way.
To be fair though, it's easier when you're that sort of trader with that sort of size, isn't it?
It is, yeah.
Because the lower you're down, you know that you've got to pay your bills and stuff like this.
That's where the biggest pressure comes in early on.
Yeah.
That's the hardest bit early on, is that constant, like, I need to make money type of aspect.
Work as well, or they just focus fully?
Some people, some newer traders will work other jobs.
The first trader you showed us, did he work, or did he?
No, he didn't. But yeah, I've known quite a lot of people, particularly sort of when I started, a lot of people would do different jobs, things like scooter man, or that's delivery driver.
Basically.
Yeah, basically being delivery driver nowadays would be the equivalent of that. Those kind of things, to just tick up a bit of money, so you knew you had something in your back pocket. That's the hard bit. But yeah, it is. The hardest thing in trading is getting off the ground. Once you're off the ground, you're all right. You can go through a bad streak, but as long as you're far enough off the ground and you don't, ultimately, and this is not me telling people how to live, if you don't live a massively extravagant lifestyle for in your first 3 years, you probably tick yourself up to a point where even if you had a bad year, you could afford to pay your bills, your desk fee, all of that with a flat year. If you go spending 50% of everything you earn every month, your account's not going to grow particularly quickly, and you only got to hit a slightly bad patch. You've got yourself accustomed to spending a decent chunk of money every month, and now you can't. What it does is it affects, one, your lifestyle and your sort of outward perception to other people. if you're perceived as somebody who's like, oh yeah, I'll do that, I've got money, and then you suddenly haven't, people find that very difficult to actually, not.
You probably attract the wrong people to non-genuine people.
That's
Well,
also
you know.
changes your psychology if you're trading, because if you put yourself into that position then you have a bad year, you're then trying to trade to pay for your financial obligations as opposed to trying taking the settings for the reasons you
Yes, and to maintain your outward perception of the kind of character you are, which
ego.
yeah, exactly. Everyone's got an ego ultimately, and as much as people say, oh, you should have no ego in trading, everyone does. Everyone's got,
Personality.
yeah, and everyone's got this element of, you you have to have a degree of ego to believe in your ability to do it. Where you don't want an ego is your recognition that you don't know everything and there is nothing that isn't available to be learnt. That's where people's ego gets in the way, I think, more so, that they kind of feel, oh, I don't need to know this. I definitely had that myself. Definitely, so 2011, I definitely felt as though I know everything I need to do. I can turn up, I will be up this month, I know I will be, absolutely convinced of it. And that works, and it works, but what it does mean is you then don't work as hard as you should have. Like, I look back, particularly 2011 is probably the big year that I always remember looking back on, which was my 4th year. I think I should have absolutely cleaned up that year. And I didn't because, well, I'd moved to London, I was young, I fancied going out partying more so than spending 15 hours a day in the office in the middle of summer because there was opportunity relentlessly throughout the day. That's where it should have been an enormous year, and it wasn't, partly because my ego was to a degree of like, well, it doesn't matter, next year I'll make more money next year. I've made a decent chunk of money this year anyway, just keep that going year on year on year. And that ultimately that doesn't play out over time, and then it's a massive slap in the face if your performance doesn't live up to your newfound expectations. So it's easy to say stay grounded. I mean, just rather than stay grounded, just remember there's always something more to learn. You're better off to try and get better at something else than you are to assume that you've nailed it, because whatever you've been doing that's nailed it is as much to do with environment. And I could put up almost any trader, and to give you an example of that, someone who's the complete opposite of the previous, you still see the performance goes up from September, October. And that's all to do with the fact that as soon as that volatility expands and more stuff starts happening, even if you are a swing trader, you're going to get more opportunities. Moves will be bigger. You'll find those bigger performances. So, and this would be the same. Like I said, that junior trader was the same. Basically, his P&L went like that for the year. So it doesn't matter who you are and how you're doing it. But the reason I brought up these is because they're extremely different. This is someone who's very sort of process technically orientated. Whilst that sounds like reasonably straightforward, well, I know my trades and I know my strategies, click, 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 and you make money. What actually happens is they will take a lot of hits and you get this quite sort of jagged performance. That, I think personally, is far harder to deal with than being able to go, okay, I was down today, but I can make that back tomorrow. And again, and again, and again, and then you get a good day that runs for you, and now you're 5 times a normal day, and you're in a good position. I personally find that far easier to deal with, despite the fact it feels quite intense, than something like this, where you do very little for a whole period of time. There are big sort of flat streaks, and those flat streaks are because literally he's done nothing. And you're sitting there with a loss or whatever, you get there, that's a bigger loss than the previous trader's biggest loss or biggest downswing, and then just sits there and does nothing for a week.
Those areas, would you have other traders where it's just like a slight grind higher, like
Well, yeah, if you go back to somebody who's much more active, it's still not quite the same. I could probably find a different example of someone who's even more active than this one. Essentially, the more active you are, the smoother the performance is. So if you're not somebody who's comfortable taking, oh look, my P&L's gone up, oh no, it's gone back down, it's gone up, it's gone back down. If that's something that is psychologically wearing, then that's where you probably don't want to be extremely technical. The other side of being extremely technical is that you're going to take a lot more big losers. Yeah, he's got multiple losers that are way bigger than the previous, and just about managed a couple of days that are nearly as big. And ultimately, this is a game of basically your real extremes are what's going to pay you. And that's a hard thing to sort of master. It's also a very hard thing to get to a point where this style actually earns enough money. because basically you're taking if you added up the total losses, total winners, you're taking the margin difference between the two, which if you're doing enough size and taking big enough winners, that's a nominally very large amount of money. But if you scale this down, suddenly that drops quite significant in nominal terms.
Doesn't look like good risk management, losing 200,000 when your biggest day is 500,000, like to me, just to me personally.
But from a risk management perspective, there's two 200 grand down days versus 7 200 grand and more up days. So the top up day, if you look at it like this, takes away the bottom 3 down days. So that's the other way, you can cancel it that way. Top day takes away the bottom 3, the next big up day takes away probably the next 4 or 5. Very quickly you've eliminated down to here by probably if you took those days, you've probably taken off 25% of all your down days. So, but the whole point of this is that it's a different psychological game.
If, let's say, like you're having up and down days, right, during the month, how often do you expect the trader to take a payment? Just once a month?
Oh, on that sense.
Yeah.
The way people pay themselves in a variety of different ways. Most people will pay themselves a flat every month, X amount, almost every month. Then they will pay themselves additional if they want to, sort of a bonus. There's a few things that impact that. One is your desire to increase your account size. So, there comes a point where, because your split gets better, the larger your account, there's a bigger incentive to leave as much in as possible. Grow your account, that also grows your size. So people will still draw a reasonably minimal amount of money. There's a lot of value. Let's say you have a particularly strong month. You take something like August here. There's a lot of value in taking quite a hefty chunk of that out, because that's then in your bank account. So that's an approach people would also do. You kind of do standard, above average month, take half of it. Standard, above average, take half. It ultimately depends where you're trying to get to. For the sort of first 2-3 years, most people will try and take as little as possible to sort of ramp the size up of the account, and therefore the size that you can trade, because then it doesn't take as much to be able to achieve the same amount of pay. You can get paid, but if you're trading that much more size, your account will still grow, even though you're paying yourself perhaps double what you were, because you're now trading that much more size. But yeah, on the whole, people generally pay themselves monthly. Some people will do it almost on a weekly basis, and they'll just put it in week on week. Personally, I don't really see the point in that. I think what you don't want is you have a bad week because nothing goes your way, and then you've got this standard draw at the end of the week as well. I don't know why you really want to do that. I think psychologically that's more difficult, rather than just go, well, I'm just going to do this a monthly thing, because then you've got the whole month to recover. A week's ultimately too short a period of time, and you could lose a chunk and then accentuate that quite significantly by a draw. But yeah, that's essentially how people do it. You just send your email and say, I want X amount, and assuming it's in your trading account, you get it, and that's it. But generally, in terms of sequence over time, what a lot of people will do is they'll run their account up to a certain amount and then go through a period of basically just drawing almost everything for a few months, lock that into your bank account, and then try and grow your account again and do a similar kind of thing, rather than just sitting there with £1 million in a trading account and paying yourself £2,000 a month. There's not many people who are going to have the discipline to do that, or the requirement to either. You're better off to move it up, bank some of that money, because you could be £1 million up on your trading account, paid yourself absolutely nothing, have a stinking year, and now you've halved that, if not worse, and now you want to actually pay yourself a decent amount of money. One of the worst things I think could happen to somebody is you run your account up, pay yourself nothing, and you end up doing something like that, and you're suddenly in a situation where you're like, wait a second, I had £1 million and now I've got nothing, and I've got nothing to show for it.
As well when you draw it out, doesn't it?
Yeah, exactly.
Yeah, you've not paid yourself the last how many years, essentially, because all that money you didn't take, you now don't have to work for free for the last
Exactly.
to put it up.
Yeah. From a personal perspective, this is unrealized profit in your trade, and at some point you actually need to take the winner, and people don't, and they sort of run it up. It's like people who just sit in the trading game. Well, it'll keep going. That's great, but at some point you've got to take it, otherwise it runs the risk of turning back, and you look around and think, well, what a great ride that was. Or you can tell the story of how you were a millionaire and now you're not, kind of thing. But yeah, I prefer to be a millionaire than tell the story. I think that's something that is important, to actually take the money out. People don't always think about that. They kind of just see it as, well, it's just you just growing it and growing it and growing it. Don't think of it like a bank account. As soon as you do that, it becomes so easy to then assume that you've got significantly more money than you really have. And typically you'll commit yourself to stuff when you're doing well that you then pay for in 6 months, when if the environment's changed and you're not doing well, you're now forking the money out and also not earning any money on the back of the perceived never-ending bounty that was coming your way. Right, how do you check volatility environment and how do you change the way you trade considering markets volatility? For me, volatility, I've described this a few times I think in the past. I would do a little bit of space. I'll come back down. Volatility, I would consider just view it on a sliding scale and just simply do it that way. Of volatility increasing or decreasing. I don't think VIX really plays into it that much. And certainly early on, because you're not going to be able to look and go, oh, the VIX is at 20, this means X, Y, Z. You've got to kind of work out for yourself what is a good level of volatility for you, and then through experience, you're like, okay, these feel like good conditions. Oh, and that happens to be the VIX at 25, 30, 12, whatever suits you. So on the question of sort of how am I checking in volatility, it's more a case of just tracking it on a day-to-day basis. Yeah, there are certain things, and it's worth doing just as a straightforward Excel sheet if you want. And you can just do it as level of volatility, high to low, or more so I would do it as low increasing, average increasing, average decreasing, etc., etc. What you're just trying to do is get a gauge for yourself of what feels volatile and what doesn't. Yeah, at the end of the day, if you think of a market's volatile, it's a fair guess. I probably think it is as well, and most other people think it is as well. The degree of volatile is down to experience, in the same way that, in summer in England, there would be no questions around, is it hot today? Everyone would agree yes. Is it unbearably hot? Depends upon your perception of hot and your comfort with that. So that's how I'd kind of try and sort of consider volatility. Broadly, you know when it's low, you know when it's high. The degree of how high and how low you're willing to tolerate or feel that you can trade within that's a personal kind of feel thing. Personally, I struggle with volatility like temperature when it goes down too quickly. Very low volatility I find unbelievably difficult to trade because it just doesn't fire enough opportunities your way. And then, so do you change the way that you trade? Yes, you have to a degree. Ultimately, what you do and the way you trade probably doesn't change a great deal. The frequency and your willingness to trade will fluctuate. So when volatility goes up, you're going to be much more willing to trade. The main thing there is you have to sort of manage your sort of expectations of you're going to get hit for losers. You're going to take a lot more losers in a day when volatility is high compared to when it's low. Because ultimately what volatility does, and this, I've always tried to sort of think about it, is volatility will take number of opportunities from here to here. So you get more opportunities. It doesn't necessarily mean there's more good opportunities. There's just more opportunities. So that's kind of your baseline of nothing. There's a chart like that. If that's total opportunities when volatility is low, you've then got total number of good opportunities. That's then total opportunities when volatility is high. That's total number of good opportunities. So you've got way more chances to do stuff, but you've also got way more chances to actually lose money as well. That's the bit that you have to kind of cope with and deal with, that just because volatility's gone up doesn't mean you have to be trading way more. It just means there's going to be more good opportunities that you can find. That for me is sort of one of the really important things. Don't just go chasing the volatility around thinking there's going to be loads to do. It doesn't make trading easier. What it does, it creates more opportunities that you will spot more frequently. So they're not necessarily any easier to do, but they're more frequent. So if you screw one up, it doesn't matter so much and you can get on with the next. At least for me, psychologically, I find that a lot easier to deal with. If I know that whatever I do today, I've got a chance tomorrow, or it's far harder to trade. If I know I can screw up at 8 o'clock in the morning and by 8:15 I've probably got that money back, that makes your life so much easier. And it means that you kind of brush off losses far, far easier as well, because one loss doesn't matter, you move on, next trade, move on, next trade. So that's how I'd kind of try and sort of think about that. So yeah, just try and keep a sliding scale of it. You know, even if you start on this grimy and do volatility on a scale of 1 to 10, do it like that. And rather than worrying about what the VIX is, just do it on 1 to 10. And that will work quite easily, because if you score today a 3, tomorrow's either higher or lower than that. Then it will calibrate itself over time. If you start too low to start with, you might call volatility negative. At the end of the day, you're just trying to get a scale. And by tracking that, you can then go, okay, volatility's picking up. It's higher again, it's higher again, it's higher again, or it's the same. That way, you know that the opportunity is starting to come. The other thing to do as well, if you sort of go, okay, well, volatility for me is a 6, and I'm performing day in, day out, then you start going, you know what, this is good for me. This is what I kind of want it to be. And also that will mean that you'll understand quite clearly what you perceive a 6 level of volatility to be. Right, quick one from Joe. Oh, okay, that's quite relevant to the chart I've just put up there. So not too many other questions psychology-wise. With Joe, I think today dollar will continue downwards, not 100% decided whether the current high will hold. However, I do believe we'll see lower prices first. The yields are a good indication of lower prices, and seasonal tendencies are lining up for a high to be in place. I'm intrigued as to what's the yield, how you're interpreting the yields are a good indication. Like what's happened in yields that is saying to you, dollar should be weakening. And the seasonality thing, I don't know. I personally, I'm not a big fan of seasonality. I think it's one of these things that in hindsight, you can go, oh yeah, well, seasonally this happened. It's like calling a Santa Claus rally. In January, if the equities are up or went up at some point during October, November, December, it's called a Santa Claus rally. But are you going to buy equities now and say this is the beginning of it, or is this the end? And we're just going to range here and the rally started in October. Yeah, that's always my issue with seasonality. But on that, if you believe that the dollar's going up today, fair enough. This is where you need to then go and think about, okay, well, where's the opportunity in this? I was talking about the euro yesterday on the break of this trend to be your chance, and this 05.24 to 08 area. I think that's quite a decent area. What the euro is doing is making an absolute meal of it. Every time it goes up there, it goes up, it rolls back, goes up, it rolls back. I'm actually looking at it now from the perspective that I think the pound's probably a better trade on this. Because what you've got in the pound, yes, it's not come off as far, and it's not got the really dramatic exhaustion. But if this is perceived to be a general dollar weakness thing, the pound's got quite a nice crisp level there, which is 126.13. So in terms of your trade decisions, and this is the good thing about currencies, if you think there's a general dollar weakness, you can go and look around and go, well, where's the best place to play this? I think the pound now looks far better than the euro. The euro's got to a point where it could have gone, and it's made its way up into this area, and it's not gone up through it. So that would, to me, sort of suggest that probably don't want to go euro. If you want something quite clean, then I think the pound's perhaps the place to go. And you've got a bit more of a straightforward up to 60 and then 96. And I see that as your opportunity. So yeah, go for it, Joe. I don't disagree with the general dollar weakness that seems to be coming through at the moment. Another factor in that is the tariff comments overnight that did give some dollar strength get reversed. So if they're perceived to be dollar strength and you get no follow through, it's hardly a good sign from the perspective of people wanting some more dollar strength, particularly on the back of the scale of the sell-off recently anyway. So that's one of the things I'd be looking at there. The other one's gold. I think if you're somebody who likes a lower volatility, not much going on type of market, gold is probably the one. It's not done a great deal today. I don't expect it to do a great deal today, simply because of the scale of yesterday's sell-off. It's going to find it hard to do, what's that, 1,200 ticks to the downside nearly, and then not have some degree of consolidation. The nice thing about gold is even when it does these sort of sideways consolidation ranges, that's still putting in just shy of 400 ticks. So if you can get in and play reversals from extremes, there's still a huge amount to be had in this. Ultimately, it's sticking in this little range here. That's good. In fact, actually, it's probably slightly tighter. So then it does sort of tighten up, but there's still a 100 tick range in that. So I'll be looking at gold for a sort of less directional one. If it does come up, I think the single prints look pretty solid for gold as a decent place for a sell, and then just assume that you're going to end up around here by the end of the day. That'd be my main sort of assumption for gold. That's always my go-to. After any kind of large sell-off day, my go-to is always balance and just play it from any move. I'd always play these types of things in the direction of the trend. So if you've had the big sell-off, then I'd be looking to try and sell a move up rather than buy a move down, just in case you get the second day trend and this goes again to the downside. I don't want to be sitting there expecting the balance day on the back of a down day and then not being on the next leg of the down move. So I prefer to play with trend and play for something like that. Right. There's one other thing I wanted to bring up today, which is exercise for tomorrow.
Did you know about oil just shut up then?
No.
Have anything on those?
No. No, I can't see anything either.
Has anyone seen anything on those?
Oh, no.
Just look like around about the dollar or something.
Oil.
Yeah, then turn straight back on it.
Wasn't there some news about Russia?
I've tried, I can't see anything. I'm not going to trade in economics.
What time was that? 44. The only thing that I'm seeing that's come out there, so that would be,
What, just now?
yeah.
Yeah. Did you see news come out? Somebody's trying to say that. It's trading down here. What dollar move?
Has it gone up, you said?
It went up, it's come almost back. to
Yeah, it's gone
right.
straight up and straight back.
OPEC begins talk on delaying oil production.
Can't see that.
That was at 2:44.
After that, yeah.
At 244?
Yeah.
Oh, that'll be it then. Yeah, that'll be that, and it's they're giving that up pretty quick. So what, they've agreed to delay increase in production.
Delaying oil production.
Yeah, there you go. But no, I didn't see anything on that. It's not in my
Delay oil production, shortage in supply. That's why the price was
Yeah,
going
exactly. But interestingly, nobody jumped on that. There's no performance in oil, which suggests that, yeah, that's probably, where have you got that from?
down. The squawk.
Oh, right.
Right.
Oh, right. Oh, so might have heard it if we had the squawk on. Yeah, quite the move. It still feels like oil just doesn't really know what it wants to do at the moment, though. And, yeah, even given the chance to go up, I know that OPEC's notoriously flaky on what exactly it does, but even with that chance to go up, you think it'd at least have some degree of an attempt at staying up there, and it just doesn't at all. But then it also doesn't seem to actually like going down. So when it comes off, it goes nowhere. Yeah, basically, you just go bigger and bigger range, like time frames, and it just becomes more and more of a consolidation.
That's why it feels like a broad consolidation.
Yeah, it does. Yeah, well, that's mid October, and we've just gone nowhere. It's every time it goes down, it comes back, it goes up, it comes back, and it's ultimately just narrowing in from where you were. You go to a 240. Yeah, it's just narrowing in this little area here. So that's, you take it back to there, and that's still middle of October in here. But yeah, it just doesn't feel like a market that's got any real direction to it. And perhaps that's part of the problem. I think that it just you've got no one who's going to drive it when it gets to a point where it could move, because well, what's changing, I guess. I wonder if it was a denial that came after that quite quickly as well, just for how little time it spent up there. It's super quick to just roll back over. But we'll see. Right. All right, quick one. When working out size equivalent, how best to get the ATR values over what time period? Okay, because I sent that as a calculation recently to do the ATR to get the equivalent size. ATR that I typically use is a 21 period exponential ATR. So the idea being that it tries to track as close to what it weights more so the more recent days ranges. Because if you start getting, you get one suddenly very large day, that will bring in more large days. Even if it's a consolidation, it's probably still a bigger range than you take gold, for example, today. Gold's done a 400 tick range today on a consolidation day. you go back for much of the previous weeks and you're seeing struggling to get 300 ticks. So one big day will increase the size of ranges very, very quickly. So that's what I would use. 21 period exponential ATR to do that. A lot of the time you can kind of just broadly work it out anyway. Yeah, you don't have to be too specific on these types of things. Yeah, you can roughly look at it as the S&P is. Oh, what's happened there? Richmond Bed Services. Surely not. Yeah, there it was. Albeit the S&P's in a very tight range. So yeah, that's how I do that. Right. Exercise. Nice one to test people's psychology. I won't elaborate too much on it. Very straightforward. Maximize loss. Not as easy as people think. Everyone's like, oh yeah, it'll be easy. I'll lose money. And then they make a fortune. But it's a good thing to try and have a go at. The whole point is it takes restrictions away. Even if you don't believe you've got any restrictions and you haven't got a daily stop, as soon as you're allowed to lose money, people do far better, generally. So good thing to do, whatever your best up day is that you've had, if you've been tracking these types of things, go and see if you can beat it by trying to lose as much money as possible. What you'll find, or what I often see, is people massively outperform. Generally, a way that people perceive as a way of losing money that doesn't work is just haphazardly clicking at stuff. That generally doesn't work, and what usually ends up happening is they end up flat or possibly up. The key thing to this is when you're onside, try not to stay in and hope, because if it keeps going, if you were short gold yesterday, you're going, it'll be all right, it'll come back. It suddenly doesn't, and you can't do anything with it. So don't fall into the trap of hope. The only rule is that you can't just click buy, sell, buy, sell, buy, sell at market and take a one tick loser relentlessly, because that would be the easiest way to do it.
So we have to deliberately try to take trades that are going to lose us money by taking the opposite of what we think would be successful.
If that's the way you think you're going to lose money, yeah. Or there's a variety of other things that you think might work. Selling every low, buying every high, chasing a little bit of momentum, all of those types of things. Yeah, go and have a go. I would suggest that you actually spend some time to plan out what you're going to do rather than just diving into stuff, but have a go at diving into stuff and see how it works out. But generally, I suggest people who just dive into anything will end up pretty 50-50 in performance. So there's a challenge for everybody. Be interesting to hear as well people's performance, how much money you have managed to lose, and we'll do a bit of a review of that tomorrow. So be interested to know if people sort of learn anything new, improve anything in the way that they trade. One thing, it might highlight some things that you previously have been doing that actually don't work. You might develop a new idea or a new way of doing things because of the fact that you're allowed to, effectively. That's the main thing behind it.
That's a really good conundrum, right? Because if your strategy is to try to short the opportunities where you would normally, try to go the opposite side of what you would normally do to make money, that's going to bring up some really fantastic questions about your strategy.
Yeah, there you go. That's the point of doing it. So there you go. That's for tomorrow, and then we'll see how people have got on tomorrow afternoon. Question from Grinding: can you explain the bund, if the auction market is important because the bund will move prior to that? I'm referring to the new issue of bonds by central bank. You take this into account for your trading. Okay, right, real straightforward on this. You want to be aware of when bond auctions are. I can explain very briefly how they work and what the general pattern on a European auction, or particularly German bond auction. And also, just to point out one thing, central banks don't issue bonds, governments issue bonds. Central banks print money, governments have to borrow money or tax. That's how a government gets their money in. Same as, think of a government as like your own house. You can either earn more money or you can borrow money, and that's the only way that money comes into your household. Assets as well, but we won't go into that. So if you want more money, the only way to increase it is earning more or borrowing more. Same with a government. So government issues bonds, right? The general pattern on a bond auction, if this is Germany, 10.20, market starts to drop. 10.29-ish, we start to get this high volume churn, 10:30 to 33, you will generally see a reversal. That's the broad pattern. That doesn't have to be a particularly big move. This could be something like 5 ticks. That's it. It doesn't have to be particularly significant. You can get some that are 15, but they're not necessarily always huge. You need to know when they are, so that when you're in a position, let's say you're long and this starts to happen, you're not sitting there thinking, oh no, this is going really badly wrong, I need to get out, only for it to go, oh, auction's finished, back up you go. So you've got to be, a lot of it is about awareness, if nothing else. If you've got awareness of it, one, you're probably not in a position, and two, you can start watching the action and see if you can find a trade in it. I've always found this to be the harder bit of the move, because it's quite subtle, any sell-off, if it happens. So you're kind of trying to play for a sell-off that may or may not happen, and may or may not go any significant distance. It could go tick, tick, tick down, and that is it. And you're then going, oh, it's a sell-off, and trying to sell that. Personally, I far prefer this period. It will generally churn, 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 and you'll get a tick out of that area. So usually this is going to be sort of a 2-3 tick range, and then you'll see it kind of lift out of that area, and that's the time to go for it. So that's the kind of general pattern of these types of things. It's a good starting point as a new trader to watch this type of stuff, because you can look at the clock and go, right, it's time to switch on. See what happens. You can track those exact periods of time and compare them all. So it's very easy to actually make comparisons, and straightforward comparisons, because you also know that what happens during this period is to do with the auction. It's not to do with something else that may not be replicated. It's to do with the auction. So, very brief explanation of what's going on here. In short, going into the auction, banks have to place their bids, how much they're willing to bid for these bonds. Now, the pricing of a new bond is going to relate to the current pricing, right? So if prices drop, what this does, it pushes yields up. This is really extreme, but let's say it pushes yields from 4.5 to 5%. That is going to be an absolutely enormous sell-off going into the auction. Not likely to happen, but that moves it up there. So now the bonds in the auction are going to be yielding 5% effectively. What the banks are also going to do, because they push the prices down, they can then bid this price in the auction for the new bonds. Effectively, what they're going to be doing is, let's say the new bond is a 4.5% bond, they're going to be bidding a cheaper price, which effectively creates a 5% yield. So they're paying under the value of the bond, and so the discount they get is effectively the equivalent of the future, of the increased yield. I won't go to the maths in it too much. The other thing you've got to remember is the banks participating in the auction, and this is why it's more of a flow thing than a results thing. The banks participating in the auction also don't want to hold these bonds outright. If you own the bond and the price of the bond fluctuates, you're at risk, effectively, well, price fluctuation. So the simple way you do that is you sell futures to the equivalent value of the bonds that you have bought. Now, what happens in a good auction is you see the positive results in the auction, and this will get people to go, okay, well, actually, we should buy these bonds because there's actually a higher demand for the bonds than we perceived, or people are willing to pay a higher price. Good sign from all of the banks who've gone and bought the bonds, time to start buying. The other thing to remember as well, and part of the reversal idea, is that some of the banks, they bid in the auction, they think, yeah, we're going to get these, all good, and they start to sell futures to the equivalent value of what they're going to get in the auction, and then find out that they didn't bid a high enough price and they haven't got filled. So now they're just short futures outright. They've got to get back out of that. And so then they run for the exits, and you get that type of movement. That's the essence of it. What you mostly want to be looking for, if you do nothing else, don't even worry about what the auction results are. The pattern's the most important part of it. If you can sort of keep trying to track the pattern, work out where you can execute, whether auctions at the moment are good or bad. Auctions go through phases. You will get periods where the auctions are wonderful and they follow this beautifully, and it does it down, it sticks, and back up. You'll get other periods where the auctions are rubbish and they will barely move down, they will sit sideways, they might go down, they might go up, and they might go nowhere, and then there's nothing to do. So you've got to be aware of it. That's why I say, plan your week out. If you know that there's a Bund auction, there was one this morning, if you know there's a Bund auction coming up today, just be aware of that going into trade. It wouldn't put me off putting a trade on, but I'd just be a little bit aware, particularly if I'm long, that it may have a little bit of a pullback on me. If I'm short, it runs the risk of coming back on me after the auction. So it's more of an awareness thing than anything else, but also just watch the pattern and go and track that. As I said with treasury auctions, if it's anything under a 7-year auction, pretty much don't worry about it. They don't have enough impact. And even more so in Europe, probably a 10. If it's not a 10 or a 30, probably wouldn't bother with it. You could almost get to a point, particularly if you're trading the Bund and it's a 5-year auction, it doesn't affect up the durations, it only really affects down. So the shorter duration the bond, the limited impact it has along the curve. So 10s and 30s, great. 5s, 2s, wouldn't bother too much. So hopefully that's covered that one. Right. Let's cover pretty much all the questions. Have a go at the exercise today if you want. See how you can get on. See if you can lose some money before the end of the session, and then we'll see from tomorrow morning until the afternoon who can lose the most money.
Is there a limit to the number of position sizes you can go into? Or
It's limited on there that you won't be able to click after a certain number of contracts anyway.
You can trade the maximum size according to the risk limits within trade rate.
Yes, yeah.
Just trade NASDAQ 6 lots.
That would also be some people's strategy. I've seen people do that. They're like, oh yeah, well I just maxed out on everything. How do you get on? Oh, I'm up 20 grand. Well, there you go. More size doesn't equate more losses. It accentuates losses if you lose, but it also doesn't make more losses. I'll leave you guys to have a go at that, and I'll catch you all tomorrow. It's all right.